What's happening, everybody? This is Mike Ferrassi coming to you with another episode of Mortgage 101. And today, we take a dive into mortgage insurance. It's a common question for new homeowners and even new originators. What the heck is mortgage insurance? Kind of like an add-on to your homeowner's insurance, right? Wrong. Let's be completely honest here. Mortgage insurance is there for one reason and one reason only: to protect the lender that gives you that home loan. Yeah, that's right. Mortgage insurance has nothing to do with helping or protecting the borrower. It's all about protecting the lender. But I guess it kind of helps protect the borrower too, because if the lender's protected against future losses, then they can afford to make more loans at lower rates to more borrowers. So maybe it's an everybody wins type of situation. But mortgage insurance is going to be required on all conventional loans with loan-to-value ratios higher than 80%. It's just a requirement of the loan program. It's because the borrower doesn't have a ton of equity in that house. And when the equity gets smaller and smaller and smaller, the risk to the lender gets greater and greater and greater. And when that risk gets to a certain level, the lender's risk is higher than the borrower's risk. So the lender wants to be insured against the possibility of the borrower walking away from that home. Does it completely absolve the lender of all losses? Absolutely not. But it does help cushion the blow, and it's a big deal. So if you're a homeowner or a prospective home buyer looking for a refinance or a purchase, and you don't want to worry about the mortgage insurance, make sure that you have 20% equity or you're putting at least 20% down, because that 80% loan to value ratio, that's the magic number where you can drop off the mortgage insurance requirement and you won't need to get it. Now, this is different on FHA loans. FHA loans are federally insured and they have mortgage insurance on all transactions, no matter what the LTV. It's just how FHA works. So if you have an FHA loan, or if you've ever done one before, you know that all those FHA loans, they're going to have mortgage insurance, and the lender is always going to have that backing and protection by the Federal Housing Agency. And VA loans too. All VA loans have mortgage insurance. Now, it's not called mortgage insurance. It's called a guarantee, where the loan is guaranteed by the Veterans Administration via the guarantee fees that all the veterans pay on those VA loans when they acquire them. But what do you think a guarantee is? That's a guarantee to the lender that they're not going to take it in the shorts if there's a loss on that transaction. So that VA guarantee, also a form of mortgage insurance. So for all of you out there who didn't know what mortgage insurance was, now you do. It can be pricey, but it's all risk-based, and it depends on the actual LTV and loan characteristics of your specific transaction. So if you're looking at minimum down payments and minimum FICO scores and higher loan amounts and things like that, your mortgage insurance is going to cost a lot more than somebody who's putting a gob of cash down and has golden credit, who has never made a late payment in their life. Mortgage insurance. Insurance on a mortgage for the lender, not the borrower. As somebody who's in the mortgage industry, I don't mind it. I think it's a good thing, and it helps a lot of companies function and make home loans more affordable to millions of borrowers. But if you don't agree with me, I can't exactly blame you. This was Mike Ferrassi from Mortgage 101, and we'll talk to you guys next time.